Welcome back, guys. Okay, so now we're going to actually look at the question and work to apply our understanding of IFRS 15 to the different parts of the question. Like I said, we are not going to go through every single line of the solution. It's more of an approach kind of thing of how to approach reading the question, how to dissect the required, how to set up your solution or your response, and then how to help that direct you. Yeah. So our question is Printco. You'd have read Printco as an entity that is in the industry of providing printers and stuff. So always read, in my view, read the actual scenario so you've got a view of what we're talking about. But then read the required so you can understand what is being asked of you. What are you being asked to do, right? And when I say read the required, don't just read to move. Read to ensure that read and dissect to ensure that you understand, are there multiple parts to it? Which standard am I in? Which part of the question am I in? What is the doing word? Am I discussing? Am I preparing journals? Are there any exclusions? Are there any additions? Make sure this is all clear to you before you even attempt. Because the risk, and I know it's hard, because sometimes it feels like it takes time. Sometimes it feels like we're taking a long time just trying to understand what's being asked of us. But the risk with not taking that time is that you end up assuming, because you didn't read correctly what has been asked of you. You assume what's been asked, and you spend all your time for that question answering the wrong thing. Or you misallocate your time for that question because you didn't realize there were two parts to the question, and now you're only answering one part. All of those things will significantly impact your ability to pass the question, right? So as much as it might feel like it's taking long, rather invest the time up front. I'll always emphasize plan, plan, plan. Plan, 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 right? Take the time up front to understand what's been asked of you and plan, and then use that to set up your response. Okay. So today we only look at part B and C. So part B requires that we write a memorandum to financial director of Printco in which you advise her how she should recognize and measure the revenue transaction with Africa Quest for the year ended 31 December 2022 in terms of IFRS 15 revenue from contracts with customers. Then you see they've told you this master communication as well as for critical thinking. So to dissect, what that means is we first understand what is required of us. You're going to write a memorandum. Memorandum means two key things before we even start. Why doesn't it let me create a comment? Sorry, guys. There we go. Okay. So we'll write a memorandum. And what that means is one, format. That will get you the communication marks. Secondly, it means discussing. All right, discussion, which then also means we need the IPAC. So after a discussion, I will have IPAC at the top of every page where I think I'm going to deal with this. But right, step one, IPAC. Step two, IPAC. And IPAC is identify the principle. Identify the issue. Identify the principle. Apply the principle. And conclude. Okay, discussion. So think IPAC. Gives you structure. Okay, so that's one part, right? So I know I'm going to earn an easy communication mark by just getting my format right. Then I know who the audience is, very important, right? Because it tells me how to respond. Do they have account understanding? Do they have the time with the IFRS references? Easy answer, pretty much no one does. But don't waste our time with IFRS references. You don't have to. If it makes you feel better, you can include them, but we just generally don't do it. Then they want us to tell her how she should recognize and measure revenue. Right? So we know recognition is steps 1 to 5. Measure is steps 3 and 4. So in this instance, they want everything. So when they say help advise how to recognize and measure, that means all 5 steps. Always very key, right? Because sometimes they'll just say how to recognize. Sometimes they'll just say measure. But you need to know what that means. And not just in a revenue context. All the standards, as you would know, are split between recognition and measurement. So you need to assess what they're asking. They're asking recognition, measurement, presentation, disclosure, and that will guide you as to which part of the standard you should be looking at. Okay? So recognize and measure all 5 steps. One of the critical things with revenue is if they tell you to recognize, generally, right? That means 1 to 5. But like we said before, you can't do 5 without 3 and 4. So there will be something where they'll probably say with calculations, because those calculations will require that you actually determine the transaction price and allocate the transaction price. But because the focus of the question was recognized, don't spend too much time discussing the measurement. Use the measurement to support your discussion recognition. You need it because you can't do step 5 without it. So use it as supporting calculation, but don't spend too much time doing the discussion because that's not the crux. But we need the numbers because you can't recognize revenue without steps 3 and 4. Okay? So revenue, this particular question, recognize and measure everything. So the memo must speak to all 5 steps. Then, the question has a few different parts. So they're telling us exactly with who. So this focuses us where to focus on the question. Right? We need to look at what is happening with Africa Quest. That's where we're looking. And then always, which year? So always be key because in multiple questions, I'll speak to 2 different years or 3 different years, and you need to be able to zone in and as to which transactions affect this year. And that's a very key word, affect this year. Not just what happened this year, but affect this year. Because sometimes the transaction could have happened in the prior year or been initiated in the prior year, but still has an effect in the current year. It's very key to be able to assess which transactions affect the year that we're being asked to provide the information on. Okay? And that's that. In this one, there's no exclusions, there's no additions. We know we need to write a memorandum on all 5 steps of the revenue recognition model. So what I would then do is start off with that one. Yeah. Start off with the structure. Let me earn my very first mark, my communication mark, by just simply putting up a memorandum to, from, subject date. I've already got 1 mark. I haven't even had to think yet. I haven't had to try to figure out what's happening in which step. I've already got 1 mark. Okay? Then I move. Then I would then set up the different headings. So start with identify the contract with the customer. Okay, because you're doing all 5 steps. So start with identify the contract with the customer. You've got 5 considerations there. Move to the next heading, identify POs. So leave some space, right? Identify contract with the customer, leave some space. Identify the POs, leave some space. We're going to use that whole, what did I say? That technique we spoke about earlier. I'm going to use that technique here. Spit out the promises. Then for each promise, assess capable of being distinct, assess distinct of the contract or contract, then conclude, right? Throw a shortcut, but anyway, right? All 5 for all the promises. Then step 3, transaction price.
Hello, can you zoom in your screen?
Okay. Ooh. Sorry, let me try to find a middle ground. Don't try to read the words that you're going to come back to the words or the detail. Is that fine? Can we see?
Yes.
Perfect. So we determine the transaction price. Okay. Leave some space. So we aren't answering. We're doing this because it's giving us structure. We are doing this because we need, once you get caught in the detail, it is so easy to get fumbled. It's so easy to forget parts. It's so easy just to run around. So we are doing this, setting up the heading so that we know what we're looking for. We know where to go. Okay, so determine transaction price. Allocate transaction price after some space, and then recognize revenue. And when you get here, I would then, okay, I can't do this yet because I haven't assessed the POs, but I know now all 5 steps. I am happy. Okay, I am happy. I'm feeling calm because that's another thing about planning. Another thing about planning is it gives you time to calm down. It gives you time to say, yeah, you know what, you read this question like, oh my gosh, I don't know what to do, I don't know where to start, I don't know. But doing all of this, sitting at the first part, you've earned 1 mark, gives you some confidence. The next part, you know the structure. You're reminding yourself that you do know something. As you read it, you remind yourself, ah, man, I know these 5 steps. I've got a structure, I've got a plan. Now, I move back to the actual question. Okay, I've got my structure. I read my question. And then I will, as I read the question, answer the different parts of the, or fill in the different parts of my structure. Okay. So I'll read my question. Like we said, we know that Printco manufactures and sells printers, which they are called ZX printers, and the year end is 31 December. I'm not going to do it now, but I am also a very big believer in the use of timelines. I think that's a very good tool that helps you sort your information as well. It's not as difficult when you've got a 31 December year end, but when you've got other year ends, like a June or September year end, I find that the timeline makes it easier for your brain to see visually whether this transaction relates to the current year, the prior year, the next year, because our brains, I mean, you've grown up doing January to December, so we know that our minds do very easily. But getting the right 12 months when it's in between, that tends to be a little bit harder. So I strongly suggest using timelines. Always helps to see when transactions happened. It's also an easy way, in my view, to remember and to refer back to when you're trying to answer without having to go and read in the paragraphs again. So it saves time. Instead of having to go and search for information in the paragraphs, you've got a nice short visual representation at the top of your page of the key points that you've observed when you first read the scenario. Okay. So we're told that Printco began to experience a decline in sales from the beginning of November in 2022 due to demand. So their solution was to run a promotion. And the promotion was that customers who purchased 5 or more printers during December 2022 would have qualified for a 10% discount on the ZX printer, on the ZX printer selling price, and received a free 2-year service and general maintenance plan. The pricing on each of the components and terms at the time is listed in the table below. Having read this, what are we thinking? When we think, and this is a key thing about each paragraph you read, and maybe I should say this now. When questions are put together, we don't give you any information for vibes, right? If you're reading a whole paragraph and you can't see anything relevant, you need to read it again. You are not present. You aren't giving it the attention it deserves. You aren't critically evaluating it. We do not go around writing an entire paragraph and nothing of this is going to affect any part of your question. Okay? It will affect something, whether A, B, or C. So we read this and we're like, okay, we know we need to do something. We need to worry about all 5 steps in the review process. Which of the 5 steps or which item do we think could affect either of the 5 steps that we've read so far? Pamela?
Hi, Kanye. There was a question, comment in the chat to ask that, may you please zoom your screen?
Oh, sorry, did I, oh, it was the solution that I zoomed, okay.
Thank you.
Okay, perfect. Okay. All right, so in that first paragraph, what are we seeing? What is triggering something we've spoken about? Whether a potential PO, something about the transaction price. What are we seeing?
10% discount.
Yes, what about it?
It's affecting step 4 when you determine the transaction price.
Step 3, but yes, transaction price. So
Step 3, okay.
It's transaction price. Why? Because it causes variability. Right? So we know part of what we're going to discuss, possibly, because we don't know about the Africa Case contract yet, but chances are we're going to have a discussion on the variable nature and the variability. I want to talk about variability, must determine what is causing the variability, the 10% discount, consider the constraint, how it affects it, if it is relevant at all. So we're going to have this discussion. Okay. What else? What else? Think of step 2. Amogela?
What I see is the free 2 year service as well as the general maintenance pay. So we would have to assess whether it constitutes like a separate performance obligation or it's one obligation with the FedEx printer.
100%. So we are going to look at the printer and the free 2-year service plan and see if it's how many POs. All right. So do we have 1 or 2 performance obligations? Anything else?
I think there's also, but then it's also like talking to the next table where it says that there's an average competitor selling price of similar printers. I think it can help us with the methods of allocating the transaction price.
Correct, right? So when you look at this table, they've given us our print code's estimated selling price and also given us the competitor selling price. So remember we spoke about allocating the transaction price. We said we need to consider there's a hierarchy of what you prefer, right? For allocation, we need the standalone selling price, first price, Camilla? Okay. First is the observable price, which would be our standard selling price if we know it and it's observable. Second would be the competitor selling price. Third would be expected cost plus margin, and the very last undesirable is residual amount. Okay. So in this case, they've given us these two, and what they're testing is if we know which of them to use. And this time we've got a selling price, an observable selling price. So I would then maybe highlight this block so that I know that I'm going to use the amounts, the estimated selling. These are the amounts I'm going to use. Printco's actual estimated selling price, because we have them for every single item. So when we need to allocate, assuming these are all POs, when we need to allocate to the POs, we are going to use the estimated selling price, Printco's estimated selling price for that purpose. It represents a standalone selling price. Okay? So in this table, they then give us the ZX printer price. They start with a 30-day, 100% money back guarantee. Camilla, what's happening there?
He had asked to get a link to access the study material. So he's just saying that it's giving him an error.
Oh, okay. Okay. Sorry, we'll assist. We'll get the caretaking team to assist after the lecture. Zintle?
Ma'am, what's the significance of the competitor's price now? Because I'm looking at it and I'm seeing that the average competitor is 265, whereas we are charging 280 now. Is there because you say no information is irrelevant, so should we consider it or should we ignore it as yet?
So at this point, the reason is provided in this question, and it's not irrelevant. The reasons provided is to test if you know which of the two to use. Right? So when I say it's not irrelevant, it doesn't mean you have to use the amount. It means it's there for a purpose. In this case, the purpose is to test whether you know that our preference will always be the observable price, and only if we don't have it, then we use this. Use a competitor's price. So in this case, I highlight green so that I remember when I'm actually answering the question that I must use this column. I've made the assessment, I thought about it, remembered that in terms of allocation, we want the observable price, or we prefer observable price. So that's what I'm going to use. So I highlight this column green. I'm no longer going to worry about this. If we had, for instance, we had both prices here, but over here, we didn't have an amount here, we only had an amount here. Then for the printers, we'd use the 280, but for the service plan, we'd use the competitor's price because that would be the best option we have at that point in time. Does that help? Cool. Amokela?
Sorry, ma'am, just a quick one, right? The standalone is our first preference. So if we do not have a standalone, then there are those three whereby we have the market assessment, the expected cost, and the social approach. With those three, can we choose either one? We do not have to follow a certain hierarchy, right?
Okay, so first, let's just get the terminology right? Standalone selling price refers to all of them. The standalone selling price is determined either by the observable price, market adjusted, cost plus margin, or residual, right? Standalone price, the standalone is what we're looking for. And there's 4 options of how to get there. Our first preference will always be observable, which is this one. If we don't have it, the next preference is expected market. If we don't have that, the next preference is cost plus margin, and the very last one is residual. So it's not if you don't have observable anyone. There's an actual preference and hierarchy. Observable, competitor, cost plus margin, and residual.
Okay. Okay. So all of these are standalone prices.
Yes. All of them are what we are using to estimate the standalone price. All 4 of them are being used to determine what is the estimated selling, what is the standalone selling price.
Okay. Thank you.
Cool. Cool. Okay, so the second part on this table speaks to a 30-day, 100% money-back guarantee. So we're told that the guarantee allows customers to return the printers should they change their minds regarding the purchase within 30 days and receive a full refund of any amounts already paid. During the first 5 years, only 1% of all printers has been returned by customers for a full refund. What are we thinking about there?
There should be.
Okay.
Is it maybe we should now recognize a right of return?
Yes, so now we're thinking, is there a right of return? Possibly there is what seems like refund liability / right of return. Right? And what does this affect? Which step does this affect?
Three.
Agreed. We're in step 3 again. And here I didn't do it. Let me also do this here because this is going to affect my allocation. So step 4, right? I'm going to use this price for my allocation. Then, oh, Precious.
I also want to ask if that the policy is to say within 30 days, just bring back the printer, we're gonna fix and give it back to the customer. What is the difference between that and the right of return, or is the one and the same thing?
Good question. I'll answer that just now. Zinhle?
My question is, in this scenario now, is there a need now, because we are it's asking us to advise on the recognition in the measurement, is there a need for step 1?
Yeah, good question. Okay, so first question, right of return. In this scenario, they say we're going to give you your money back, versus a scenario where they say we are going to bring it back and we'll fix it. Those are two very different promises we're making to a customer, right? Because the first one, what we're saying is, if you bring the printer back to me, I'm going to receive my inventory and give you your money. So I'm going to increase inventory, reduce back. You're getting your cash back. So it's going to affect my possible transaction price. With the other one, we are saying, if something's wrong, bring it and I'll fix it and I'll give it back to you. I don't have a liability to refund you, right? I'm not saying I'm going to give you your money back. I am actually, in that case, probably providing a warranty. In that case, I'm actually providing an assurance type of warranty, where I'm kind of guaranteeing that this product I'm selling you is going to operate as intended. Sorry, I heard something from someone. Okay. So it's going to actually indicate that actually I'm saying, if something goes, I'm betting on my product. I think I've created an amazing product. And you know what? Things happen. So if something is wrong, bring it back, I'll fix it, you keep it. So I won't have a refund liability. It's not going to affect the transaction price I can recognize. What is going to happen in that case is that I might have a warranty. And warranties affect whether what I have to assess there is whether or not the warranty is a separate PO, or i.e. is it a separate good or service I'm delivering this contract, or is it not a separate PO? So it's different considerations. Great question. Zinhle asked if step 1 is relevant. Yes, step 1 is relevant because it asks us to recognize and measure, and step 1 is part of recognition. So if you actually go into the standard, I just can't remember, I've got to still have it open. If we look at recognition, the very first part of recognition is identifying the contract. So step 1 falls within recognition, and therefore it is relevant in this question. They ask us to recognize and measure. Mokela?
Sorry, ma'am, this is just going to be out of context with regards to warranty, right? So, if then that's the case, we have a warranty like that, but we don't have the amount because it's probably going to be the same it's not a separate performance obligation. But let's say now we've somehow there's a present obligation that exists as a result of past events. It's just it's uncertain in terms of timing and amount. So I'm assuming there's a provision, isn't it?
Could very well be. So I had skipped this, but let me bring it back. With warranties, can you guys see the warranty decision tree?
Yes.
So with warranties, it's not always a given that it's not a separate PO. It could be a separate PO and it might not be a separate PO. So it depends. For instance, do we sell them separately? If we do, separate PO. If it's required by law, not separate PO. Is it an assurance type warranty? So is it me guaranteeing that I'm betting on my product, it's going to be amazing? Trust me. If it's not amazing, I will fix it and give it back to you. Then it's not a separate PO. But if we get to a point that it is a separate PO, obviously we'll treat it in terms of IFRS 15, we'll have to allocate TP and all of that wonderful stuff. If it's not a separate PO, you're correct. We most likely, if it meets the recognition requirements of a provision, i.e., it's a past event, it's an obligation as a result of past events and from which future economic benefits are likely to flow. Yes, we will likely have a warranty provision. And then we'll have to do estimates and treat it according to IS 37.
Okay. Is it only in a scenario whereby we will not be providing an additional service whereby we would recognize it as a provision?
Where we are?
So we're saying that there are two types of warranties. You can either be providing a service and in addition, then there will be a separate performance obligation, right?
Yeah, so if you're providing a different service, if it's for one, if we sell it separately,
Yes.
separate PO. And if it's
Yes.
not required by law and it's not an assurance type service, separate PO. If it is assurance type service, probably not.
Okay, so what I'm asking is that a provision will only be happening or we would incur only a provision if it's only versus an assurance warranty. It's not a separate PO.
I don't like always, but in most instances, yes. So in most instances, it will be an assurance type or something required by law. So you see all our no's here, all the non-POs speak to assurance type or required by law. So in most instances, it will be assurance type or required by law. I can't think of a different circumstance now, but there could be other circumstances. But yes, in most instances, it would be an assurance type that would not be a PO.
Okay, no problem. Thank you.
Cool. So this decision tree you guys do have, and I do suggest using it whenever you do come across warranties. I just hit it earlier on because time is obviously not on our side. But please use it, even for this question, use it because there is a warranty in this question as well. Yes, Pamela?
Hi, Kanye. Is there a decision tree in the standards for the contract modifications as well?
Standard, that's a good question. I actually don't know.
Okay.
I actually don't know if it's in the actual standard itself. I mean, it's not in the body. I just don't know if it exists in the examples. I don't think it exists in B. Let me just have a look quickly. I don't actually know.
Okay, I was looking for it as well.
No, I don't. It's not here, but it's in the slides. I mean, I know the slides, you can't take the slides with you, so that is not great. But the point of decision tree is that you just get comfortable with it, right? So that you know how to use it, how it flows. And then if you work with it enough, it kind of gets glued in your head
Okay.
eventually. Yeah, I don't think they have it. Yeah. Don't have it here. Okay. Okay. So over here, we've got a refund liability. Step 3, transaction price. Oh, here I didn't write here. So there's a reason I'm doing all of this, right? Writing because I need structure. I need a plan. Like I'm not reading all of this for vibes. I am not reading I'm not making all these notes for vibes. Remember, I set up my structure earlier. I set up my structure so I know what I'm going to discuss in all 5 steps. The reason I'm making all these notes here, so when I actually start to fill in my answer, I can easily come back and say, oh, this was step 2. I need to consider the POs. Or this was step 4. I considered possible variability. I considered refund liability. So I considered variability because of a discount. I considered variability because of a refund liability. I considered, and that was gonna inform my discussion. It's gonna give direction to my discussion, and it's gonna make my discussion complete, right? Because one, as I'm making all these notes, I am breaking this information, this very big amount of information, down for myself. So I know which parts are relevant for which part of my answer, right? It also, so it helps me break it down so that I know which parts I'm going to need to use for my answer. And that also makes it easy for me to come back and quickly jump back to, so that I know, yes, put it in there, yes, put it in there, instead of wasting time going through it. But also it's helping, in my view, make it make sense. Like, why are they giving me all of this stuff? It's also helping me use all my information because there's a reason for the information. And if I assess it critically, I know what the reason is. And if I know what the reason is, I can then use that to inform my response. Yeah. So you're asking how relevant are the standards for June IAC? They're very relevant. They are, I mean, they aren't large new standards that are actually effective. So I mean, there are new standards that have been issued. IFRS 17 is effective, but it's not within the scope of IAC. So you won't get there. You won't get tested on IFRS 17. IFRS 18 and IFRS 19 have also been issued, but they aren't effective. So you don't actually need to worry about those for IAC. Any updates that have been made to the standards and are actually effective, they are, you can see that on the ISB website. So the IFRS.org website, you can see updates. But in addition to that, you can also Google standards issued and effective, because, well, you can Google it, and most entities, it'll pull a few links, because a lot of entities disclose that information, right? They kind of, they're entities that share that information, that knowledge out there. Also, in every entity, any listed entity, the financial state, well, in any entity really, IAS 8 requires that you disclose any new accounting policies and whatever that you've used in the year, or any that are upcoming and will be relevant for your thingamajig, and be relevant for your entity. So in any listed entity, because you can find those financials easily, for any listed entity, you can pick up those financials and go through a few different sectors, see their standards issued not yet effective or standards issued and adopted, and that'll help you get a view of the recent updates and recent standards that are issued. But obviously the best source will always be the IFRS or the ISB website. So IFRS.org website will always be the best source to get any up-to-date information. And always remember, we only need to worry about what's effective. Anything that's been issued but is not yet effective won't be tested. Okay. Becky, I'm not sure what you're asking when you say any plans on how to plan your answer, because that is kind of what we are talking to. So look, this solution that is currently incomplete, sorry, I don't know where, oh, here it is. I will share it as well, but on this solution, I've got the different headings, but I've also got notes on what to think about for each of the POs. Okay, so this will help you, I hope, when you're answering the revenue questions on, now that you've got the structure, how do we then keep going? How do we then actually respond to each step? Today's class will conclude at 13:30. Okay. All right. Which one was I doing? Okay. So we've made the note of this one. We kind of spoke to this one, the warranty, right? So they spoke about the warranty. So we spoke about decision tree. That was actually the comment I was just going to make here to say, okay, in this case, use a decision tree to assess whether or not you've got a separate PO. Okay. Then the last thing is a 2-year service plan, which covers an annual service, general maintenance, and replacement parts in the event of a printer malfunction. Okay. With this, again, or actually not just with this, if we look at everything here, this table essentially helps us with the very first part of our step 2 response. The very first part of the step 2 response is identifying the promises. This table has given us all our promises. We're offering a printer, money back guarantee, a warranty, and a service and maintenance plan. So we already have a starting point. We've got 4 promises, and that is what we will use to, well, I actually have a lot of documents open. Is what we'll use here in part B, because remember the first step of step 2 will be identifying the promises in the contract. Okay, so very first thing here is we'll note all 4 of those things that are in that table. We will then apply the remaining steps from this slide to all 4 of those promises. So define the PO, define a PO, apply customer perspective, apply entity perspective, and sub-conclusion for each, for all 4 of those promises. But the first thing will be listing those promises, right? The goods or services in the contract. Okay, so that was us kind of pulling out different key things to know and to refer back to. Okay, so one of the things you need to practice is being able to pull stuff out of your scenario to enable you to answer and to structure your response. Okay. Then in this part, they give us actual detail of the sale to Africa Quest. So it tells that Africa Quest is an existing customer of Printco. They're taking advantage of the special discounted offer, and they're taking 10 printers, and the total price they are paying is 2520. And this happening on 30 December. They then give us the payment terms. They're paying 30% today or 30 December, and the remaining 70% within 30 days from that date. And this is in line with the normal customer business practice. Okay, then they give us the journals the bookkeeper presented or provided. Happiness. So what we're going to do in this case is also pick up key things in this paragraph. Pamela?
I didn't mean to interrupt. You can just finish and then I'll ask a question after.
No, ask the question because we're not going to do the detail on this paragraph. Go for
No,
it.
it's not related to I just wanted to find out as well how soon can we start booking consultations?
That's a good question. I wish I had an answer for you. I'll confirm, but I mean, don't rush to consult yet. You need to first actually work through this by yourself, right? Because right now we're speaking about a plan. I'm giving you an indication of a plan to use to respond to the question. And of course, then I'll give you the worked solution, my worked solution with my comments, but you still need to take the time to actually do it. And then you can book the consult once you know which areas you're struggling with. So I don't think it'll be consult in the first week, in this week. I'll confirm with the team when the consult will be, but we need to give you time to actually do your own reflection before you come and talk to us. Otherwise, it's going to be a waste of your time. Remember, guys, you already know more than you think. You really do. You already know far more than you think. You just don't trust yourself at this point. After having worked through this with a plan, working through a question with an actual plan, you're able to see how much you're actually capable of without me. You'll be pleasantly surprised at how much you actually don't need me to talk you through the question, and how much once you've got a plan, you can shoot this thing out by yourself. So yeah, not in the first. I don't think in the first week, but they will announce on Viva once those are available, on Viva Engage once it's available. Amogela?
Hi, Penny. Please excuse my extreme questions, right? But in a scenario whereby there is a refund liability that was recognized, right? Maybe they say in this instance the 1% that was recognized for the returns or the refunds, and then it happens that there's a contract modification of the transaction price. So there's 100% of the full transaction price, only 99% was recognized as revenue, and then there's only 1% that was recognized as a refund liability because we're not sure whether the customers will return or not. In the midst of that 30-day policy, then there is now a contract modification that changes the transaction price. What happens to the refund liability? and the revenue to be recognized.
Okay. Very big question. So we've got the refund liability, we've got the revenue recognized. And if it's similar to this question, our refund liability or refund period is only for 30 days. Okay?
Yes.
And within the 30-day period, we change the contract. But what, from my understanding, our change to the contract is this scenario, where we continue to account for the existing contract, right?
Yes.
Okay. So what we do then is we keep the refund liability, we keep the revenue, but based on what the change is, we'll make an irrelevant adjustment. So let's say initially we recognized, let's make it easy, 99, is that even easy? 99 Rand as revenue, 1 Rand as refund liability. So our initial total transaction price was 100 Rand. Then now we are changing our transaction price, and our new transaction price, right, for the contract is 110.
Yes.
What we are going to, and this transaction price is for this amount, this 99 that's recognized, is for the actual goods that have been sold and delivered already, right? So this 99 is for goods already sold, already delivered. The
Yes.
new price of those goods sold and delivered, this 110, we are then going to allocate similarly 99% to revenue, 1%. So we're going to add in it, and for that 10 Rand, we'll add 9 Rand to the revenue and 1 Rand to the refund liability. So exactly the same.
Okay, but then isn't it that we're saying that the revenue for the 99 is already recognized and we do not do anything with it? The only problem that we have is it's this 1% that we're not sure whether it will be returned or not.
But remember, for this one, where we continue to account as an existing contract, there is an effect on the revenue as written in our books. Because when you continue to account for the existing contract, what we are saying is there are no additional goods, but there's more money in this case that we are earning for the goods already delivered. But
Yes.
of this more money, right, our new transaction price is now 110. And
Yes.
the same thing is true. 99% of that is what we are comfortable with. 1% is still a refund liability. So we still need to make sure that of our 110, 1% is a refund liability. So 1 Rand of 110 won't be 1%. We'll need to do the calculation of what 1% of 110 is. And that's what's going to go to refund liability, and the 99% will go to revenue.
Okay, so which means we would additionally recognize the revenue that has already been recognized and additionally recognize the refund liability that is already recognized.
Yes, so for the goods that have already been delivered, only for the goods that have already been delivered, we make a change on that based on the transaction price.
Okay.
And that's for scenario 2. That's how scenario 2 works. Because scenario 2 doesn't create a new contract. Scenario 2 makes an adjustment to the existing contract.
Yeah, because I thought that we do not focus on what is already sold. I thought we only focus on what is still needs to be delivered, or in this instance, we are not sure about we have basically the revenue that we have not recognized. That's what I thought.
Yeah. And that's true for scenario 1 and scenario 3. But for
Okay.
scenario 2, because we don't have a new contract, we're still working with the existing contract. So scenario 2, there's no separation between what happened before and what happened after. They're all being seen as one thing, and we're making sure that we're still using the same step 1 to step 5, no new contract, so it's all intermingled when it comes to scenario 2.
Okay. Makes sense. Thank you.
Cool. Okay. Yeah, the modifications, we definitely need that breakdown across the 3 examples, and hopefully that helps a bit to shed some light. But yeah, let's see. What do I want to say here? Okay. So we now have we know all the information we need on the printers. I wanted to highlight here that there's a difference here, right? That they're taking delivery on 30 December 2022, but they're only paying 30% on this day and 70% in the future, right? So here we have to consider a significant financing component. Okay, we're considering it. We're going to conclude that it's not relevant because of the 30 days. So we're going to use a practical expedient, but we need to consider the significant financing component. So we need to make this note here. Okay. And then we'll go, and after using all these notes, we'll then go into our solution. You see here where I said I'll highlight in red. This I wouldn't do. It's a waste of time in my view to repeat this theory. So I've highlighted red. It's not worth your time to repeat this theory in my view. Doesn't add any value to anyone. I will then go to, okay, I still need to do part 1. I need to go back to consider step 1. And what I'll do to get that right is, if I forgot what the criteria are to identify the contract, I will go back to my standard. I'll open IFRS 15, go to the section where I've flagged to identify the contract, and then I won't rewrite the sentences, right? I will rewrite contract approved, and then I'll apply IPAC. Parties' rights, identifiable rights of each party, apply IPAC. Identifiable payment terms, apply IPAC. Commercial substance, apply IPAC. And probability of collection of the consideration, apply IPAC. So I will not rewrite these sentences. I will just rewrite the principles, identify the rights, identify the payment terms, commercial substance, probability of collection of consideration. I will rewrite it and then I will apply. Okay, that's what I'm going to do for step 1. And see how, as we were thinking of all of this stuff and making all these notes on our work scenario, the one thing we did not think about was step 1. We made notes everywhere. So if we had not set this up like this, we might completely forget to discuss step 1. And then you're going to lose quite a few marks because we're just going to completely forget about it. But because we've set it up in such a way, we remind ourselves to then come and do it. And then again, I would write step 1, and for each step, IPAC. Okay, every single step is a discussion question, so that I remember IPAC, IPAC, IPAC. Okay. I will share this with you as well, and I will color code because we need to. I want to highlight to you guys where the principle is, where the application is, where the conclusion is, so you can see how to apply that in the scenario. And that just goes on for all of them. Do the same thing. For step 3, what I wanted to highlight was in step 3, we noted a few things, right? So we noted variability with discounts and refund liability. So start there. Start speaking about the variability and then speak about discounts and finish the discussion. Speak about refund liability, finish that discussion. Then go to significant financing component, finish that discussion. So don't try to put everything together. Think about it logically. What is it? It's a variable consideration. We've got variable consideration. What's affecting that? What's causing that? 10% discount. Then we speak, what does that mean? How does it affect the transaction price? Is there a constraint? Conclude. How does it affect a transaction price? Then refund liability, same thing. Significant financing component, what's causing it? Is there practical expedient? And then conclude on that as well. So for step 3, we had a lot of considerations. We need to break that down. So we'll see a lot of the discussion would have been in step 2 and in step 3. Okay. And then the key thing for step 5 was to remember to first start with what's recognized over time first. Yeah. I had wanted to work through the journals, but we're not going to have the time for that. So I just want us to have a look at what the required was, right? So required was us to prepare the journal entries to account for the contract entered into with the NewsCo for the year ended 31 December 2022. For this contract, we're going to assume that the practical expedients have not been used, and this is in terms of contract costs. We're going to ignore closing journal entries. Okay. So the thing with NewsCo is over here, and the actual detail is that PrintCo's got a tender. They're going to construct this printing press for NewsCo at their premises. Okay. This should be ringing bells. We're going to construct something on someone's premises. we think step 5, revenue over time. We're taking the second criteria where we are creating or enhancing an asset that the customer controls. So those are the lights that should be flashing in your mind at that point in time. Okay, so management is very excited, and as it was the first of its kind for Printco. First of its kind indicates that we probably do not have enough information to make a reasonable estimate as is Printco, because we don't know this. So if they want us to complete this in a specific amount of time, we actually don't know. So we probably have to constrain any potential bonus payments because we don't have enough information. Anyway, so we start this on 1 October 2022, and we expect it to take 7 months to complete. We're going to get 21 million in totality for this contract. And this 21 million is payable 7 monthly installments. Again, think, is there an SFC? Is there a significant financing component? Is there a difference between delivery and payment? Because are we not in this case actually delivering over time and receiving payments over time? But think about it. Is there a difference? Is there a significant financing component? There's a bonus of 4 million payable by Newsco if it's completed before the final days of delivery, so before 30 April. And what I said, we do not know, right? We actually do not know yet, okay? However, they say at the end of December, Printco was confident it'll be able to complete the press before that date. Then they give us additional payments that will be made by Newsco during the year of December 2023, based on the printing press usage only for that year. Okay, then they give us this usage. Love it. This probability, they say it's actually reliable because Newsco has been in this business for a while. So they actually know how to use this and how to make this estimate. And then Printco's an estimation of the costs of the project will be 15 million, and the sales commission. And we've also got an estimate of how far we are, our stage of completion for those products at the end of December 2022, which is 35%. And none of our expectations, of Printco's expectations, have changed by the year end. Okay. So all of this tells us a lot has happened. But like I said before, for us to be able to record journals, we need to, you don't just end up with a journal, right? For you to end up with an amount in your financial statements, you essentially have had to go through the whole process. We have had to sit here and think, like, we're not going to get the marks for writing and discussing all that, but we've had to think this through. Like, what is our promise to Newsco? Essentially, the printing press. Is there any other thing we've promised them? Doesn't look like it. We are just going to provide them a printing press. Then, well, we start with the, is there a contract? Is there a print, or what is the PO? It's a printing press. What's the transaction price? And that's what we said to start. We have to actually do the calculations now. I had done this. Let me see if it's still open. Probably shut down when I had to restart my laptop. Okay. But essentially what we then need to do is think to say, okay, I have a few amounts that are promised to me. And of these amounts, I have the initial amount of 21 million. Okay. There's a bonus. I think that's 4. Then there's usage. And there's a whole calc to do there. Okay. Oh. I need to work out based on okay. So I've got that 21. My bonus, like I said, it's constrained, right? So I'm not going to include it. My digital payments, which is the print usage, there's a whole calculation there, which adds to that, and that gives me my total transaction price, right? So for the entire contract, the whole 7 months from 1 October to 30 April. So this is where a timeline would have been very useful, right? If you had the timeline, it would help you think through this. To 30 April. Okay. We know at year end we're 35% complete. So we're able to work out that's our revenue. This is how much revenue we should have by 30 to 31 December 2022. Then we think, okay, in a revenue transaction, or in this particular transaction, which journals do we actually need? Okay. Obviously, the most obvious one is we need a journal to recognize our revenue, right? So we must, at some point, have a contract that has credit to revenue. Okay. Got the credit to revenue. We've calculated the amount, so we know how much this is. The question is, what's the contra? Typically with revenue, our contra will be bank if somebody's paid us. There'll be a trade receivable if somebody owes us money. Or there may be a contract liability. They've got a contract payable here or contract liability. So in this case, if we think about it, they told us that they're going to pay us 3 million. They're going to pay us 3 million every month. So in October, November, December, we're going to get 3 million times 3. So we know there's an amount in the bank. So bank will be 9 million. Revenue calculated. The difference is a credit. So it's not a receivable. So it's a contract liability. What's a contract liability? When the customer has paid an entity for revenue that's not been provided. You've got a contract liability when the customer has paid, but the entity has not yet provided that service. Right? So they've paid in excess of the performance obligation provided. And that's the case here. They've paid 9 million, but we've only earned 7.8 of the revenue. So how should we have thought about this journal? I know I need revenue. I know it needs a contra, and the contract revenue can only either be bank. For the debit side, it can only be bank or trade receivable. And I've got bank, so I put it in there. Then the missing amount is a credit, so it has to be a contract liability because they've paid me more than I've delivered. Okay, first part, very, very logical. Then we also know that part of IFRS 15 speaks about contract costs. An incremental cost of obtaining a contract, for instance, would be stuff like commissions. So the commission, if you've got staff that you promise a commission to if they bring certain contracts in. So for those costs to be contract costs, they would need to, one, be only incurred if this contract is earned, and they must be recoverable from the contract. In this case, we believe this 1.8 of payment commission will be, is only going to be earned because we've got the contract, and we believe it's going to be recoverable from the contract. So what that means is, again, we have to pay out bank. So bank, whenever there's a bank leg, it's the easiest leg because you know that there's a bank leg, there's a bank entry. If you're going to make a payment or receive a payment, very easy. Use that, right? So we know there's a payment going out of 1.8. We know there was contract costs. What we do is we amortize them over the period of the contract, unless we use a practical expedient, which they said we're not going to use this time. So we going to amortize these costs over the 7 months of the period of the contract. So what that means is, of this contract, we have to count how many months have elapsed by year end. So it'll be October, November, December. So for those amounts that have elapsed, we're going to expense, right? Because we've got a contract cost. To amortize means we're going to expense part of it. So we're going to expense 3 out of the 7 months that have elapsed to P&L. And the remainder will be held as a contract cost asset. All right? So we'll say 3 out of 7 will be the expense, or we could have done the inverse first. We could have done the contract cost. So 4 out of 7 as a contract cost, and the other is the balancing figure. If we do it this way, the remainder is the balancing figure. Okay? But we made a payment. The payment is a contract cost. We know we need to amortize contract costs. Therefore, a portion needs to be an asset at the end of the year, and a portion needs to have been expensed. You could have also done it differently. You could have started off by having the first journal, so breaking this up, having journal 1 being bank 1.8, contract cost 1.8. Then had a subsequent journal where you actually amortize. So you amortize for these 3 months. So you have contract cost amortized in P&L and amortization, and then a credit to contract cost asset as well, the P&L. And the last part is, naturally, if you're going to have revenue, you typically have a cost of sales. So in this case, you've got the contract expense, that they're calling it here. So remember, so it's actually thinking back to, if I'm doing revenue, what do I need? I need to know if I've got money or a trade receivable. I need revenue. I need cost of sales. So those are the journals you start off with, or the legs you start off with, and then you contra them out. You contra them out and you do the calculations to help you figure out what the contra is in each instance. And that is the structure, I'll say, for the journals. I'll add commentary here as well, so it's easy to work through and remember when I'm thinking of the journals. I'll also add the alternative. Let me make a note here. I'll add the alternative. And then you guys can work through that. All right, guys, that brings us to the end. Apologies for going over. I hope something has landed and it makes sense. And I hope that when you work through this and other questions, the structure you've worked through will help you make some sense of it. But thank you so much for your engagement. Thank you for being present, even for the extra time that you've taken. Tomorrow, Austin will work through leases with you, and then I will see you later in the week for other sessions. Have a lovely weekend further.
Sorry, before you end the session,
Yes.
I just want to ask something, because I don't know if it's anxiety or the stress. I don't know what to do, because some of my friends that passed the exam, so they were telling me, no, you should just start straight doing the questions, the ITC questions, like do as much as you can, you know. So at this point, I don't know. Okay, so should I start with the questions? Should I just go straight to the? Should I just read the, what you call it? Should I understand the theory first, or so? Yeah, I'm kind of confused. Like, okay, so should I just jump straight to the questions?
Okay. Like I said earlier, please don't do as many questions as possible. That doesn't help, right? The intention is never quantity of questions, it's always quality of questions, and how much time you spend getting the planning right, getting the structure right, and the reflection. So for instance, with this question, you can go and do this question, okay? And then after doing this question, what you would need to do is have a very honest reflection with yourself to see where the key issues are. Okay, the key issues, typically you'll figure out whether it's technical and where the technical is, and if it's an exam technique. If it is technical, figure out where that technical is and then focus on that area. Okay, focus on that area and revise that knowledge. So for you guys like, you've gone through this. You've gone through the standards multiple times. They were drilled into it in CTA. So there's no way you don't know anything in any standard. So with you, I would recommend doing a question, not as many questions as possible, but doing a question. Like for instance, with revenue, print co. With leases, I think it's pipe as you want to discuss in class. So I would structure it in that way. Do the questions you're going to cover in class, do your honest reflection, and then based on that will inform whether you need to spend more time in IFRS 16 or more time in IFRS 15, and that will guide which videos you should watch if you need to go back into a standard. But the purpose of doing a question is to identify the gaps. Don't try to just do as many questions as possible. Do the question with the intent to identify where the gap is, and then start to fix it. So yes, you can start the question, but don't try to finish the question bank. That will not be helpful. Okay? Does that help?
Yes, thank you.
Khomonza?
Yes. Hi, Kanye. How are you?
Good, and you?
I'm good, thanks. Thank you so much for the wonderful lesson, a great presentation. Listen, I'm having some issues logging in with regards to accessing those materials. Would you be so kind to just email them to me? If I can just drop my email on the chat box, even if it's just this question you were doing today and the solution, because I tried to reach out to a lady called Vanessa. There was a phone number that was posted in the previous chat, the previous lecture. So I can see that they're not responding. So maybe it's because it's the weekend. So can you just kindly send me the question bank that you're doing now and the solution, please?
So, Khomoto, tell me, are you struggling to log in to Viva totally?
Yes, basically I'm struggling to access the AIC portal. It just gives me an error message that I screenshotted and I sent to Vanessa, but there's no response.
Okay, so, but you can get into Viva Engage
No, I can't.
at all. Okay, so you can't get into Viva Engage at all.
Yes.
Okay. I'm not supposed to email stuff, so let's figure out. I'll figure out a different way to do it, and to get in touch with you guys. I'll just post in there to please post in the chat that if you could please give you access or help you with access to. I mean, you have posted already to the question bank, and then we'll start to work on that. I know Charmaine as well, but we'll go through the chat and see who we need to reach out to try to sort out your login issues.
Okay, so right now in the chat, if I understand well, I just need to post my issue that I'm experiencing now and my request for the
Yes.
question bank and what the email address.
I mean, you can post email address, but I probably won't email you. I'll probably send it to your Viva, but we'll sort out your access shortly.
All right, thank you so much.
Cool. Zintle?
I would just like to say to Usaki and to send the email to admin@Endonam, the admin email address. They do respond because I encouraged something this morning and they responded. They would respond. The admin thingy email. They do respond. Thanks.
Cool. Khomonza, I hope that helps you as well. Happiness?
Okay, if you can just drop that email address for admin in the chat, then I'll send them the email now, please.
Cool. Zintle, please assist. Happiness?
Yes, sorry, I just wanted to confirm with the question bank, I see there's a solution at the back. So can we still use the solution while we're waiting for this one?
Yes, you can use the solution. Solution is correct. The only reason I have this one is because this one, the only reason I'll share this one is for comments, and the structure and all that stuff. So the structure will be very similar in the solution at the back. It just won't have my comments like you see right now on the screen.
Okay, thank you.
Cool. Felicity?
Hi, can you see that? And thank you so much for a great session. I'm just gonna try my luck, ne? So I see on our notes, ne, you have nice references in terms of the chapters. Maybe let's say BC's financial instrument, and it gives us a question that we can deal with. Do you have that for the rest of the maybe content or chapters in accounting that someone can do? Maybe if I know I'm struggling with non-current asset, a reference to a particular question that I can use, or maybe I can find it, go CTA content or something.
So currently, you're saying the question bank only has reference for the top subjects we are going to cover, hey?
Yeah, mostly on the technical. Is it the note, the technical
Yeah, the
note?
phase
It's only
note,
on the
yes.
subject. Yeah. So I wanted to know if maybe there's something that we can use for the other chapters, probably, that can reference us to a question that we can look at too.
We do have it somewhere. I must just find it.
Okay.
I just need to find the reference for the question bank. And then we'll let you know once that's been included.
Okay. No, thank you so much.
Oh. All right. Cool, guys. Have a lovely weekend. Thank you so much. You guys have been amazing. Looking forward to chatting later in the week. Goodbye.
Bye.